this week's market update, trade tops the bill after China and the US exchange tariffs. Brexit is in focus as talks between the government and Labour falter ahead of the European Parliament elections. Elsewhere, US data and UK results are the main focus for investors. Trade tensions are top of the agenda for investors this week as China and the US square up to each other with tit-for-tat tariffs. President Trump kicked things off last Friday by imposing higher tariffs on $200 billion of China's exports to America. Yesterday, China retaliated with higher tariffs on $60 billion of US goods. Like the US, China is raising the import tax from 10% to 25%. That in turn prompted the US to confirm a threat to raise tariffs on a further $300 billion of imports from China, effectively bringing all of that country's exports into the net. Shares fell in many markets, with the S&P 500 down 2.4% yesterday, its worst drop since January. Nasdaq was off 3.4% and the MSCI World fell nearly 2%. The Chinese currency also fell, crossing the 6.9 yuan to the dollar mark for the first time this year. Overnight, the rout spread to Asian stock markets, with Chinese shares off another 1%, as was the Topix in Tokyo. China's quick response followed a series of provocations from the Trump White House, which has appeared to be relishing the new confrontation between the world's two major economic powers. The president's latest contribution was a tweet warning that China would be hurt very badly if it did not compromise. "You had a great deal, almost completed, and you backed out," he said in a series of remarks on Twitter. It was left to the president's economic advisor Larry Kudlow to attempt a slightly softer tone, suggesting that the US and Chinese leaders would probably look to meet at the G20 summit in Japan at the end of June, with a view to signing a deal then. The consensus view remains that the US and China will end up striking a deal because it's in no one's interest for them to engage in a prolonged trade war. But investors are still taking risk off the table, with lower share prices in a range of markets. The latest falls in Chinese shares add to last week's 4.5% decline, and the knock-on impact was felt across developed and emerging markets. Currencies were in the spotlight as well as shares, with the Turkish lira falling almost 2% against the dollar. The US is accusing China of backtracking on previously agreed terms, a charge the Chinese delegation denies. China just wants a deal premised on equality and dignity, it said. The big concern remains that President Trump may overplay his hand and overestimate the Chinese desperation to strike a deal. The market's fear is that a negative feedback loop of lower share prices, economic slowdown and rising prices could send the US towards a pre-election recession. Although China is clearly a big loser from the brewing trade war, President Trump will know that there are big risks at home too. Shares in Apple fell 5%, while Boeing was 3% lower. Caterpillar shares also fell sharply. All are companies with a big exposure to overseas, especially Chinese, sales. Manufacturers are joining America's farmers, which were early victims of Chinese tariffs. US soybean shipments to China effectively stopped last year after Beijing retaliated with its own 25% tariff. Recognizing the problems of US farmers, the government last year authorized a $12 billion bailout program, but it's a signal that no one can win a trade war, however confident of victory President Trump appears to be. Worries elsewhere in the world are that what Trump has thrown at China, he might soon turn on other regions. Europe is concerned that the US-China talks will set the tone for its subsequent negotiations with both parties. The car industry is particularly in focus, with Japanese manufacturers also in America's crosshairs. As equity markets fell, investors sought out safe havens. The 10-year government bond yield fell around 7 basis points, the most in 6 weeks, to just 2.39%, a 15-month low. Gold had its best day in nearly 4 months yesterday, up 1.1% to just shy of $1,300 an ounce. And the Japanese yen rose to 109 to the dollar. It hasn't been higher since February. The impact of trade tensions on the US economy will come into sharper focus this week, with an economic calendar stacked full of updates on housing, manufacturing and consumer spending. Retail sales will be the highlight, with a modest 0.2% month-on-month rise penciled in. The quarterly corporate updates, meanwhile, are more or less over for the first quarter season. Just 9 companies from the S&P 500 are due to report results this week, including retailers Walmart and Macy's. The corporate spotlight is brighter on this side of the Atlantic, where we have results due from big property investors Land Securities and British Land, retailers Kingfisher and Burberry, as well as EasyJet, National Grid, Thomas Cook and Sage. The bigger focus at home, however, is likely to be the endless political wrangles over Brexit and the future of the Prime Minister, as we move towards a European parliamentary election next week that promises a catastrophic result for the government. Latest opinion polls show the Tories in 4th place, behind the Brexit Party, Labour and now the Lib Dems too. Some polls even put the Conservatives behind the Greens, as support hemorrhages from Britain's 2 main parties. What's unclear is whether Theresa May can remain in Downing Street after such a calamitous rejection. The European elections are typically a bit of a non-event from a market perspective, but this time they could have a bigger impact thanks to an expected swing towards right-wing populist parties in a number of countries around the region. The investments most likely to be vulnerable are probably Italian government bonds and, in the UK, gilts and the pound. Finally, the IPO market was back in focus this week after Uber followed rival Lyft to market and fared almost as badly as its rival. Having already erred on the side of caution with an IPO price of just $45, the ride-hailing app's shares have fallen a further 15%, including 10% yesterday, as weak market conditions amplified market scepticism about the ability of the company to move into sustainable profitability. The market value of Uber shares at $37 is now less than $70 billion. That compares with initial hopes for a $100 billion valuation. Lyft, meanwhile, which came to the market at $72, is now priced at less than $50.